the odds look like they're tilted against getting anything before the election. We had anticipated that we would get stimulus of $1 to $1.5 trillion. Back in July, that seemed like a pretty reasonable thing to expect. A lot of commentators back then saw it almost as a done deal. I think as time has passed, we've been reducing odds on that happening, and then I think in latest, over the last week or so, it really seemed to diminish to the point where we really kind of took that support out of our outlook for growth. I guess I would say it's not. I wouldn't totally throw out hope for a stimulus, but the calendar here is moving in a way such that we don't have a lot of time until we really get into the heart of the election season.
Yeah.
When that happens, I don't think there's much prospect of getting it.
So you're talking about now about a 2.5% GDP quarter for the fourth quarter, which would be ho-hum at any rate, but certainly coming out of the depths that we're in is not that encouraging. The big swing that you see is in kind of disposable income as well, and that goes back to the stimulus checks. I mean, from where you sit, is it those checks to households that are the biggest factor here that you'd be watching for in any bill?
Yeah, I think that's right. So in mid-April, once those checks went out, you saw consumer spending turn around pretty quickly. And so were we to see another round of those stimulus checks, I think that would give a pretty substantial fill-up to household incomes and to consumer spending in the fourth quarter. Without that, we do still think the economy pulls out positive growth here. We don't think we're in for a double dip even without the stimulus, just because of some of the momentum we're seeing in the economic indicators. Looks pretty favorable, but it's definitely not, as you point out, Kelly, we would like to see more robust growth given the high level of unemployment and the still pretty deep hole we're in even after the very impressive third quarter.
Yeah, fair enough. And Nisha, I want to bring you in and talk a little bit about some of the fraying signs that we're seeing in the credit markets, especially in high yield or so-called junk parts of the market. We were talking about this on the show yesterday as well, but there has been more defaults lately. What can you tell us about conditions in a part of the market that the Fed itself is supporting? So you would have thought it'd kind of be taking this in stride.
Yeah, and I think the majority of the defaults, and it's important to really make note of this, has been in the sub-investment grade, non-rated space, and it's been really concentrated in a few sectors. So these are nursing homes, these are charter schools, very small project finance types of deals. They don't typically have access to the MLF, which was set up by the Fed. What I think the misconception is that there's going to be an increase in defaults in the investment grade among states, among cities. And we certainly don't think that's the case. So while defaults are on the rise, more of that possibly going to occur kind of, over the next, let's say, 6 to 18 months. I think a majority of that will be fragmented kind of amongst those heavily concentrated sectors where we've already seen those defaults. And unfortunately, additional fiscal stimulus may not always feed through to those types of entities, right? Nursing homes, charter schools, specific type of retail type of, let's say, strip malls that are being built out.
It's fascinating, though, because nursing homes are obviously one of the most vulnerable parts of the economy here with COVID. You'd think that they would, if of anybody, would kind of qualify for more support than they seem to be getting. But I know there's a long history there. Let me ask you as well, because you mentioned this, and I think this is also important. So for Mike, the importance in many ways comes down to those household stimulus checks. For you, a lot of it comes down to state and local aid. Is that right? I mean, how important is it that there's money going to states in the next bill?
Yes, I would say a few months back, states and municipalities were fairly hopeful that the next round of fiscal stimulus would include a pretty decent package for them. And right, a lot of these municipalities, a lot of these states are at the front lines of fighting COVID. As a result of this, their healthcare costs have gone up. But it does unfortunately seem less likely that may come about. And again, as we're discussing just a few minutes before, they're pretty low probability of it. So I think a lot of states and cities have already positioned themselves to not depend upon any federal aid, unfortunately, and try to make additional cuts. And so all of these states, as they release their budgets for next year and the year after in 2022, they're already positioning themselves to make additional spending cuts, possibly furloughing workers, more decreasing funds to in-state programs. And so we've already seen that in the past few days. I think we will see more of that if this bill does not get fast-tracked.